All right, everybody, welcome back to Money Made Simple with Oakwood Wealth Partners. My name is Nick Lockwood. I'm one of the financial planners on the team here. And as always, I'm joined by my dad, Mike. Dad, how are you doing today?
I'm doing well. So you made a comment about my glasses. They're just readers, okay? So I'm not blind yet. So just bear
Okay.
with me for a little bit. So
Okay, yeah.
I can see
I've
you
noticed
better
recent
from here.
Yeah, I've noticed recently one of my eyes is definitely weaker than the other one, so it's time I think to get back to the optometrist. But hey, so we're excited today. This is our first episode where we're bringing a guest onto the podcast. So I wanted to introduce Dom. Dom Pappalardo is from Morningstar Wealth. He's a he's a partner of ours and that he's a resource to us. And I think, we're really looking forward to getting some of his insights. Before we get going here, I want to just read a little bit from his bio so that you get a sense of where Dom comes from and some of his experience. So, Dom Pappalardo is the chief multi-asset strategist at Morningstar Investment Management LLC. Renowned for his expertise and leadership in investment strategy, Dom plays a crucial role as a public-facing ambassador representing Morningstar Wealth's multi-asset capabilities to investors through a variety of media channels. His work ensures that complex asset class views, macroeconomic insights, and portfolio positions are communicated effectively to audiences ranging from individual investors to advisors and institutional clients. So, Dom leads the production of insightful commentary and research intended to engage and inform Morningstar Wealth's diverse client base. He acts as a vital link between Morningstar's investment team and its clients, and he's instrumental in enhancing visibility and engagement around the firm's highest conviction strategies. So, with that said, Dom, why don't you introduce yourself? Give us a little bit more background on where you come from and some of your day to day.
Yeah, great. Thanks, Nick. I know that was a mouthful on the intro, but first of all, very happy to be here with Nick, with yourself and Mike. Thanks for having me. Kind of cool to be the first external guest on the podcast series. Just a little more detail. So I have about 25.
We'll have to send you a plaque or something, Dom.
Yeah, exactly, exactly. As long as you sign it first, I'll take it. I have about 25 years total of investment management experience. The first 20 years or so, I spent more on the fixed income side of the markets. Started as a trade settlement person, did trading myself, managed portfolios, and eventually oversaw a core investment management team. Um, about 5 years ago, I transitioned to Morningstar, where I took the role as the head of the institutional investment management team, where we did a lot of the firm's custom mandates for other platforms, third-party financial institutions, things of that nature. And then in 2024, I had the opportunity to take on this strategist role, which has been really fun and a little bit different and provides me the opportunity to talk to folks like yourselves in situations like this.
Yeah, Nick. So he's a lot smarter than us. Okay, and he's in Chicago, so there's that too. The one thing I want to make sure that we touch on is Dom is not going to sit here and give us advice on where to necessarily invest. He's just going to give his outlook, kind of what happened last year, a little bit, and a little bit about what he sees going forward and some of the signs to look for as we as investors and people saving for retirement are kind of trying to navigate through a lot of this complexity that's happening currently, especially currently. So I don't know if that Nick, that kind of helps you a little bit there.
Yeah, so the goal for the podcast today is we want to go through some of the topics that have been grabbing headlines over the past 12 months and even year to date so far to start 2026. We're filming this in March, so we know that things happen quickly and there's always updates going on, but I think our conversation today is going to touch on a couple different topics that should be of interest to most folks out there. So the outline here, we want to spend some time talking about the economy, interest rates. So that's been a big point of conversation recently. We also want to spend some time talking about international markets and the weakening of the US dollar that we saw primarily in 2025. And so, what do we make of that? And then lastly, no conversation at this point seems to pass up on AI and artificial intelligence. So we want to get some insights from Dom on what he sees as AI relates to investors and the economy more broadly. So I think with that, you guys, the plan here is we'll go through a couple different questions. Both of you guys can give me your responses or your take on these questions, and we'll go from there.
Great.
Okay. So, Dom, maybe let's start with you. When you look at the economy today, how would you describe the overall environment? And so for our listeners who are trying to figure out what it means for their own financial lives, what are the most important things that they should actually be paying attention to with all this noise that we're hearing?
Yeah, Nick, I think you framed it well in your opening comments there that you should really start looking back on 2025. And 2025 was a bit of a surprising year from an economic perspective. The word resiliency comes up a lot when we talk about what occurred in 2025. Factors like GDP held up much better than expected. Inflation actually was much more in check in 2025 than was expected. And the reason those things were expected to weaken was because of the tariff announcements we got in April of 2025 around the famous Liberation Day news conference. So once those relatively surprisingly high tariff rates were announced in April, most forecasters and economists believed that GDP would come down and inflation would go up. Well, those things really didn't happen through the second half of 2025 the way people thought they would. The economy was actually much more resilient than forecasts were calling for. That did carry over into 2026, but we had some other events come up that really perhaps derailed that resiliency a little bit. So Q4 2025 was strong. Q1 2026 not shaping up to be as strong. And part of that is just kind of a timing mismatch. Some things have run through the system. There was a lot of inventory buildup in 2025 that spurred a lot of activity. That was a one-time event because of the tariff implementation dates. So in 2026, that activity declined dramatically. We also very recently have seen the escalation of the conflict in the Middle East, which has caused energy prices to spike, and that has a whole host of economic impacts, none of which are really positive unless you're the one selling energy. It causes inflation to go up. It causes interest rates to go up. All things that are effectively drags on economic activity. So we really have hit a bit of a tipping point. It's where that resiliency from 2025 seems to be leveling off and potentially declining as we enter kind of the end of Q1 2026.
Yeah, yeah, that makes a lot of sense. Dad, do you
Yeah,
I mean,
Dom,
what do you think? What
it's funny because one of the questions we were going to ask and we decided not to, but if you go back to April last year, right, when they announced the tariffs and the news media just took off with it and how terrible everything was going to be, and we heard from our clients, this is terrible, this is terrible, this is terrible. And our job, Nick and our job obviously is to hold their hand through it and say, okay, let's kind of separate the noise from TV to your actual investment portfolio. Um, do you have any I mean, that happens a lot in our world, right? Where we as financial advisors
Mhm.
are constantly battling news media and trying to take some of the fear away from on what being pushed and broadcast out, um, for advertising dollars and trying to bring it back home. Like, okay, does this really affect you and your portfolio? Do you hear from other advisors with those same types of kind of challenges?
Absolutely, Mike. I think that's one of the probably the biggest challenges that advisors in general face. And it's part of your job, as you're alluding to, is to guide your clients through kind of the noise, quote unquote. And, the hope is that there's already a very thoughtful and disciplined investment plan in place. And I feel that advisor's job then, after that plan's created, then their job shifts to ensuring clients are willing to stick to that plan. And that becomes especially challenging in the time periods that you alluded to, where headlines and noise, panic, emotion, kind of all the things that detract from discipline are spiking all at the same time. And we at Morningstar believe that's absolutely paramount to a long-term successful investment track record is being disciplined during those times. And quite frankly, if anything, that should be a time to revisit new opportunities as asset classes kind of reprice or overreact to those headlines that may actually be an opportunity for your clients to either reallocate or perhaps consider some different asset classes that maybe weren't part of the picture previously.
Right. And I think we're going to touch on that a little bit later, right, Nick? Yeah.
Yeah, so it sounds like 2025 was actually a pretty resilient year for the US economy and just kind of taking what I got from that so far in 2026 we've seen a little bit of softening. Maybe I know The jobs numbers recently ticked up just a little bit as far
Yeah.
as a percentage goes. So, just something to keep an eye on. Let's jump to interest rates, because interest rates, they were rock bottom for years and years. And then in 2022, we saw a massive increase in interest rates, which for our folks, our clients who were in maybe a standard 60-40 portfolio, right? Not only were they hit on the stock side of their account, but also the bond side. So that was a really challenging year for investors. And since then, right, interest rates have stayed high. That means mortgage rates have stayed high. So as we're progressing into this year, we've started to see interest rates come down a little bit, and I think the expectation is that they will slowly continue to go down. But Dom, from an interest rate perspective, what are you guys seeing, and what do you think investors and our clients should be looking out for?
Yeah, great context there, Nick. And you're right. 2022 was historically the worst year for kind of aggregate fixed income portfolios that we've ever experienced. So that was without a doubt the low point in terms of fixed income investment returns. Uh, 2025, we saw the Fed cut interest rates 3 times in the second half of the year. And typically, as the Fed's cutting interest rates, you would expect overall interest rates to fall. And that didn't necessarily happen. Interest rates sort of stayed flat, let's just call it range bound, but no meaningful move lower. Certainly not enough to change the equations that you're talking about, whether it's mortgage rates or other financing vehicles that the average consumer might have to utilize. So that's a bit of a disconnect there, where you see the Fed going one way, but the interest rate market's kind of holding pat and not following suit. It was expected that the Fed would continue to cut rates into as we rolled into 2026. Expectations were for 2 or 3 more rate cuts in 2026. Those expectations have declined, and that's because we've seen that spike in energy prices I alluded to a moment ago. As those prices spike, inflation concerns are also growing. If inflation is uh, a concern to the Fed, they're very unlikely to cut interest rates, because typically as you cut interest rates, it adds fuel to the inflation fire. And that's the last thing the Fed wants to do. So the probability of those cuts has come down pretty dramatically. The Fed meets next week. There's almost a 0% chance they cut. They meet again in April. They meet again in June. June is the first meeting following Chairman Powell's term. They were expected to cut in June. It was about a 60 or 70% likelihood if you look back a month or so. Now it's down to about 38% likelihood as of this morning. So part of the reason for that is that increased inflation that I alluded to earlier, Nick. So at this point, it's really unclear where interest rates are going to go from here. But no doubt that financing costs have risen since 2022, and that is a challenge for the average consumer out there.
Yeah, Dad, from our meetings, right? I hear a lot of times we tell our clients, they'll ask us something good or bad, and we say, "Well, it depends." That's kind of our joke, is that it always depends. So when interest
Mhm.
rates were low, right, it came with some good components. Mortgage rates, those were down, so it was easier to buy a home. But your money market rates were not paying a real competitive interest. Interest rates go up, and now mortgages are expensive, but your money market's paying a little bit more. So, Dad, for our investors and our clients, maybe you could spend a little bit of time talking about interest rates going up and down, and what folks can maybe do or should be thinking about as it relates to their retirement outcome.
A couple things. I mean, I was thinking about the interest rate. We refinanced our home, right, when interest rates are low, and we got a 2.95 on a 30-year. And for us now, if we wanted to sell our home, we'd have to find another home and basically probably half the value to say have the same mortgage payment, right? Because the rates have gone up. So a lot of homes are not being sold too now because of that, right? So many people my age refinanced and got it locked in that low interest rate. It's hard to get out of that low interest rate when you're there. Um, but Nick, this when we do our planning, interest rates are a component, and they're usually, um, we always ask our folks, how much do you have in your sleep well at night fund? And the sleep well at night fund is the money in the bank, right? It's not invested, but it's we can get an emergency. And the more interest rates drop, the more folks are looking for alternatives. And that's kind of where we have to kind of come in and tell that, okay, yeah, it's not so good, but this really is still your sleep well at night fund. And we can't be too aggressive with it. But those that have the flexibility, right? That they've got too much in there. There's a lot of opportunities when interest rates are going down because as you know, bond yields are usually helping out a little bit more, and so we've got a little bit choice around that. And again, you've got to be fluid with this too, because you never know. You don't want to really try to get locked up into something, and that's the other challenge too, right, Nick? We have a lot of folks that as soon as interest rates go up, they lock it up into a 5 or 6 year annuity, and which is fine for some folks, for some of your money. But we can't just because interest gone up just throw everything we got into an annuity because we're not locking that rate. So it's a very it's a cautionary tale when interest rates are kind of going up and down. You have to be really, really careful and not getting locked up, right? We see a lot of CD laddering too, right, Nick?
Mhm.
With a lot of our folks with interest rates. So yeah.
Yeah. Yeah, interest rates, it'll be interesting to see what ends up happening there. I mean, you mentioned you had your mortgage locked in at 2.95, I think you said. I seem to have bought my house at the peak of interest rates because mine's 7.5%.
No,
So
no,
I
your grandpa bought it at the peak of when interest rates were
Okay, okay.
14%.
Yeah, fair enough.
If you were
As
extra
far as
self.
long as I've been around maybe or in the house buying market, but, I'm watching for those rates desperately to go down because that means that we can refinance, but that means that, like we said, those money market rates or CD rates are gonna come down. So it'll be interesting to see what happens.
One adage I've heard there that I think works really well is the savers versus spenders division. So the spenders benefit from low interest rates, the savers are penalized, and vice versa for high interest rates. They benefit the savers but hurt the spenders. So I think framing conversations with the distinction, are you more of a saver or a spender, helps answer that is it good or is it bad question that you proposed a moment ago.
But Dom, it
Yeah, yeah,
also seems like it's a generational battle, right? If I'm being very generalistic, the folks that are close to retirement, they want higher interest rates. The folks that are starting off and have credit cards and trying to get more, they want lower interest rates. And so it's the 30-year-olds versus the 60-year-olds on an interest rate battle, right? So
Okay, so we spent some time talking about interest rates and what to look forward to maybe this year for savers and spenders, as Dom put it. So let's jump a little bit to something interesting that happened last year, and that was that international markets actually had a really good year as far as the international stock market goes. We for a decade, let's say, we were always saying the international markets are going to come around. We got to stay diversified. We got to have some of our investments in international. But it seemed like every year international was underperforming, say, the S&P 500 or the US domestic markets. Well, last year it was actually the opposite. The S&P 500 I think was up 17, 18%. The international markets actually beat the S&P 500. So it was just a
by
good
double
testament
digits.
to
Yeah.
yeah, it was just a good testament to diversification and reinforcing why it's important to stay diversified in our investment accounts. So, Dom, on that point, maybe you could give us a little bit of a backstory as far as what you guys saw with the international markets last year.
Yeah, for sure, Nick. I'd start off by saying we shared your pain over the previous decade of holding international allocations that really just continued to lag the U.S. market, and it was frustrating for sure. But we really believed in the valuation, much like you alluded to. So it was, in some ways, it was nice to see that kind of flip and pay off, and maybe kind of justify some of those decisions that were made. But really, the main driver for the U.S. underperformance in 2025 was the devaluation of the US dollar. The US dollar currency lost about 10% relative to the basket of global currencies in 2025. And that was the first year in a really long time where we saw the US dollar depreciate relative to foreign FX markets. It had consistently been appreciating to it, which put further pressure on those international equity market returns. In addition to that, valuations in the US just had gotten pretty stretched. We had, let's call it, a 3-year bull run on tech stocks, capping off in 2025. We had different segments of the market adding debt and leverage just to kind of boost earnings, doing share buybacks, things of that nature, things that just really weren't sustainable for the long term. And you didn't have those fundamental issues in many international markets. Certainly some did, but we believe there are plenty opportunities to find value globally. We were big fans of emerging markets. They did quite well last year. Korea comes to mind as returning almost 100% in 2025 as kind of a standout. Some of the Latin America countries did very, very well in 2025 as their currencies rallied quite a bit relative to the US dollar. So Nick, I'm right with you. We thought that was a good reminder that when done in a thoughtful and prudent manner, that international diversification can really provide a benefit for investors and really help diversify a portfolio's risk profile.
Yeah, Dom, I've been doing this since '87, and I remember in the early '90s, we were we were beating the same drum about international. I wasn't doing anything, and then all of a sudden, it had a 3 or 4 or 5 year run where it was outperforming. I think was it a Morningstar that used to do these? I can't remember if it was Morningstar, but somebody used to do these periodic looking tables that had the highest performing asset class every year. And you could see there where international was near the bottom all the time, and then for 4 or 5 years, it was like toward the top. So we do you think we could have another 3 or 4 or 5 year run where international's outperforming domestic?
Uh, we're still overweight international and we're still underweight US in our portfolio allocation. So at least for the short run, I would say yes, Mike. I mean, 3, 4, 5 years, a little harder to
Yeah.
say, but we still think there's significant value in that international diversification. Now, that being said, we did take the outperformance in 2025 as a bit of an opportunity to rebalance. So I would say we're less overweight international today than we were
Mhm.
coming into 2025, just because we did some profit taking and reallocated back to the US in segments we thought were relatively cheaper today than they were a year ago. So short answer is yes, I think it can continue. We're positioned accordingly for that. We are perhaps a bit more selective and a bit less aggressive with that international overweight today than we were a year ago.
Do you think that there's any concern that people now that they see international have such a good run last year that they now, if they're looking at their investments, want to get into international? Is there any concern that maybe they've missed the boat, so to say, that right you don't want to get in after, yeah, I'll leave it there.
Yeah, Nick, you probably deal with it more than I do with people trying to chase returns in hindsight, which usually doesn't work out well over the long term. So I do think maybe kind of the I don't know what the right term is, but the easy wins are behind us, so to speak. Kind of the broad lift of international might be behind us. So we do think you have to be a little bit more strategic and thoughtful about how you approach it today. But again, absolutely believe there are still opportunities internationally that are more appealing than the broad US market is. So, will I encourage people to kind of dump in big allocations and try and chase it? No, of course not. Do I think that there's still a case to be made to add to international if you're underweight there? Absolutely, I do, as long as you're strategic about it.
Dad, for our clients, when we're helping to build out investment accounts, right? We have our stocks and our bonds, and that tells us generally how aggressive or conservative we are. And then between those two buckets, let's say we diversify into international and US stocks and small cap stocks, right? All sorts of different equity exposure that we can have. So when we are constructing accounts for our folks, I mean, can you give a little bit of color on how we think about building those out for people?
I don't know if I can answer that in a short time. One of the things that Dom, and you know this probably, I get worried about um, when I talk to some of my clients is they're all in on the S&P 500, right? And doesn't matter whether it's a Vanguard or a State Street, doesn't really matter. Whoever is managing the index, they're all in on it. And we've seen how the market is propelled by a certain number of stocks. And when those stocks do well, the market does well. And when they don't do well. We were seeing now a little bit about, and you're probably seeing this, values are outperforming growth at this point. And so we rotated to a traditional dividend paying type of stock portfolio with evaluations a little bit more in line than all the Googles, Apples, Nvidias, Facebooks, all those, right? Are you seeing that? Nikki, I pivoted from your question. Are you seeing that kind of um, uh, rotation amongst you guys as managers? Because I know you have some portfolios that are growth oriented, some that are value oriented, and some that are all cats, right? So
That's right. Yeah. So, Mike, I would say in kind of our multi-asset class structure, which I think is most appropriate for what you're describing, is we had been underweight growth and remain underweight growth just because of the fundamental valuations being well above our fair values that we've established. So, I think we align with that point of view without a doubt, and have been positioned that way for some period of time now.
but
What's
it's
interesting now
very
is
sexy, Dom. Dom. I'm sorry to interrupt you, but it's very sexy, isn't it, to have an Nvidia and have a Tesla and all that? But you got to be able to live and die in that world and not be reactive, right? And I don't think most investors are. So
Yeah, I totally agree, Mike. And just to be clear, we love the fundamentals of those companies. We think they're fantastic corporations and have most of them have very strong balance sheets. The price is just too high right now and has been too high for again some period of time, year, 2 years, whatever you want to call it. It's nothing against those companies. It's not that we dislike them. We just don't want to pay the current price that the market was requiring for that. Now, to your further point, as value continues to outperform growth, that relative price trade-off isn't as expensive as it once was. So we're considering what that reversal point might be, where we maybe perhaps consider moving some allocation out of value back into growth to kind of close the underweight we had there. So to be clear, we're not there yet. We haven't done that in any meaningful way, but we're trying to do some homework to kind of understand where that inflection point may be and how close we actually are to it.
yeah, again, I started back in the late '80s, and then in the '90s when the tech bubble was running. I remember a Wall Street Journal article, and you may or may not remember this, but the article was about a monkey throwing darts at a dartboard with different stocks on there. And they were comparing him against portfolio managers, and the monkey was performing better than the portfolio managers just by throwing darts. And my whole point was that, everybody was day trading in the '90s. Everybody was getting rich and thinking they had it all figured out. I remember people retiring because they were going to go day trade. They were done working, they were going to go day trade. And then 2000 hit, 2000 through 2010, basically the lost decade. And I don't hear many day traders anymore. And I'm afraid that's happening again to some extent, right? With some folks. So that's just my personal opinion.
That's
Sorry.
a great segue. Yeah, that's a great segue here into our last section that we want to cover, which is artificial intelligence. So, Dom, along those lines, my question was going to be, do we think that the big question is, do we think that this is an AI bubble, right? That's a term that we hear in the news every single day if we turn on CNBC and things like that. So, from your perspective, where do you think we are with AI? And if we're looking long term, what sort of segments maybe should we be considering to take advantage of that technological growth?
Yeah, Nick, this may surprise you, but it's not the first time I've heard that question about being in an AI bubble. So,
Yeah.
fortunately, I've rehearsed this answer once or twice before. My answer to the bubble question is not yet, and the reason I frame it that way is the companies that are benefiting from the AI rally are showing earnings growth. They are showing fundamental improvement. Sales are increasing at a rapid rate. Profitability is increasing at a rapid rate. Now, when those comments are directed at the sellers of AI technology, Mike, you mentioned NVIDIA a moment ago. They certainly qualify as that. As long as that continues, it's hard to call it a bubble because there is fundamental improvement supporting the asset class, the asset price increases. Are they in line with one another? Time will tell. We can argue the price has moved ahead of the fundamental growth. My concern is this, is that at some point in time, the buyers of the AI technology or NVIDIA's customers, for example, have to start experiencing material benefits and gains from the investments they're making in AI. I don't know when that'll happen. Nobody knows when that'll happen. It may not happen. Um, but if it doesn't occur in some period of time, they will have no choice but to curtail their AI investment. And at that point, companies like NVIDIA will stop seeing the straight line vertical growth rates that they've experienced for the last 5 years or so. So it's not a cop-out answer. My honest answer is not yet. And I think we're just a little too early to tell if that will turn into a bubble or if it will actually turn into, long run fundamental change in markets. The second part of your question is which areas do we think could be most impacted by it, or something along those lines. We saw kind of end of January, early February, a bunch of the software stocks really were punished by the market. And that was because there was speculation that new AI tools are really going to disrupt those software companies' business and revenue models, right? They basically receive a per user fee from other companies. Well, if AI tools are replacing people or replacing the software in general, that model falls apart. They're going to see substantial pullbacks in revenue. That's possible, but I think it's still like that's a little too nuanced for me to really say yes or no on. So I really think, what we should be watching for is more important. We should really be watching for the industries or companies that demonstrate meaningful improvement in efficiency from AI investment. And we just don't know who that is yet. Yeah, obviously, companies are automating manual tasks and things of that nature, and that's great. You may save a few entry level headcount here or there, but those aren't moving the needle on these massive corporations' profit growth. So I don't know yet, but certainly watch. I was just going to say, watching for efficiency gains in industries is my number one kind of indicator there.
Yeah, didn't Zuckerberg or Meta just pull back on their investments in AI a little bit? I mean, I think he just laid off some folks over there, if I remember right.
Yeah, I it's ironic, right? Because in some ways, the people that are being laid off have replaced themselves with the tools they built at companies like that. So I don't know if that means they were successful or unsuccessful, Mike. To be honest with you, but I think
That's
that
a great point.
jokes aside, the point notwithstanding is that spending on AI investment can't increase indefinitely, and that's kind of the inflection point that some companies have reached right now.
I think my take on the AI bubble question is it's just so hard to know because if AI truly makes people and businesses as efficient and productive as what's claiming to, happen once this AI is implemented, then we're probably not in a bubble. But if it's either slower to make us more efficient and more productive, or it's way less effective at doing that than is anticipated right now, then yeah, I think some of these prices probably are overvalued. So it's just such a hard thing to put your finger on and say this is what's going to happen. If we take a step back, if we're planning for retirement or we're 30 years old trying to buy a house and save for retirement, and put money in the 529 plan for our kid, um, I think you need to figure out what is the goal with my money or this portion of my money. What's the goal? When do I need that money? And then that'll help you make a good decision on how aggressive or conservative. If I'm going to be buying a house in 6 months, that money should not even be in the same conversation as is there an AI bubble because that money probably should be right in the bank getting a really boring interest rate and I know it's going to be there. So for folks who are listening, I think there's always headlines with AI, right? We don't know what's going to come out of that, but if we're trying to figure out how to invest for our families, we really need to take inventory of when am I going to need this money? How much risk am I willing to take? And then, you may not even be in this AI conversation at all if you're not willing to take that kind of risk.
I think that's what a lot of people don't do, Nick. A lot of people don't, um, I don't know, pigeonhole their money for certain, tasks, right? They put all their money in one kind of area. This is my investment, and yeah, that's investments for your trip to Europe next year, and it's your 30-year retirement from now, so in the same bucket, right? And I don't think people do that, and that's kind of where we come in. We can coach them on, having a perspective. What's this money for? What type of investments should we use with it? Should the Nvidia bubble worry us? No, probably not too much. It's a headline, but you're going to be diversified. It's not going to be all your eggs. So, right.
Right. And for folks who've worked with us in the past, kind of the whole bucket idea, right? Our bucket one, two, and three are conservative, our moderate, and our aggressive money. The AI stocks, yeah, there's probably going to be some exposure to those stocks in each of your three buckets, but most of that exposure is going to be in your most aggressive bucket of money, and that's because we're willing to go through some of that volatility in exchange for the long-term growth. So it's just a matter of understanding where do you actually have exposure to AI, and is that a good, are you comfortable with that? And then if you're not, that would be a reason to maybe reevaluate what you have, and make changes if you need to. So we talked about a number of different topics here. So we talked about the state of the economy, resilient last year, a little bit of softening this year, but we never know what the future holds. We talked about interest rates and the pros and cons of interest rates going up or down, and how that might affect different folks. And then we spent some time talking about the international stock market last year, how the weakening of the dollar propelled that up to outperform what it has done in recent years. And then, of course, we finishing up on AI. Do you guys have any kind of final comments? I guess just maybe to sum up things here, if you're an investor or you're getting close to retirement, maybe what one or two things would you take from this podcast that would allow you to better position yourself?
Well, Don, if you don't mind, let me say something real fast. Like I said, I've been doing this a long time, and Nick and I, we have folks calling us, um, and they're worried about their money because of the headlines. And I say, yeah, we've been through this before. We've been through this before in different types of headlines, not this particular headline, but we've been through this before. And invariably, everybody always says, oh, but this time it's different. It's not different. If you take that long-term perspective, you're going to see, these are going to be blips in time, basically. And that's what we have to kind of get people to keep focusing on is the long term. And I think that's what we do really, really well, Nick. People, they trust us at this point for the most part. Even COVID, when we dropped dramatically, we had one person who we let go to cash. And the only reason was because he ran a business. He was worried about payroll, and that was it. That was it. Everybody else just and that was scary times, right? So we are going to live through the 2008 and the 2009, and it will not be fun. But as long as you have a plan in place, you're going to sustain, you're going to survive, and you're going to thrive eventually. And that's kind of what we're looking for. So, Dom, I want you to talk, but I really want to ask you your name. Is it Greek? It's like kind of Italian, kind of Greek. I don't know. I was trying to figure that out.
Well, Mike, it's 50-50. Those are the two guesses I get all the time. And I'll spoil the surprise and tell you it's Italian.
Okay.
But you're right. It has to be one
Any
of those
final
two.
thoughts, Dom?
Yeah. So, Mike, I would just follow on your comments there. So, Mike, I think your comments about ignoring the headlines as much as you can are really important. And for better or worse, they're more important right now than typical. 2025 was a year where we had a tremendous amount of that noise out of the media. And unfortunately, 2026 seems to be shaping up in the same manner. And I think it's incumbent on folks like me and Nick, yourself and Mike to kind of remind people that as uncomfortable as it feels, that is normal. And almost anytime somebody's trying to time the markets, they're going to be wrong. There's a great stat out there. I had it in a presentation last year. It's something along the lines of, if you've missed the 5 best days of the market over the last 30 years, you gave up 25% of the total return of the market. And I don't know when those 5 good days are coming. You guys don't know when those 5 good days are coming. So the only way to capture them is to stay invested in the market and have that discipline to focus on those long-term goals and objectives that you both have alluded to throughout today's conversation.
Well, Dad, I don't have anything else unless you do. So maybe on that note, we'll wrap things up here. Dom, we really appreciate you joining us, and I know the folks who listen probably are able to take a ton away from the insight that you shared. Dad, I know you tried your best, but I'm just kidding. No.
I always try my best, Nick. Dom is with Morningstar Investments. They're one of our partners. But he did this out of the goodness of his heart, just to get that out there. We did not pay him a fee, and he did not pay us a fee to be here. He's just giving his time. So I want to make sure we get that out there. Thanks, Dom. Appreciate you.
Nick, Mike, happy to be here. Yes, happy to be here. Really enjoyed the conversation. Would be excited to come back anytime you'll have me.
All right. Thanks, guys. Well, that'll wrap up our 5th episode here of Money Made Simple with Oakwood Wealth Partners. We'll see you guys next time. Thanks.